Last month, I reviewed the tax situation for a high-income family, and I found that they were accidentally giving the government an extra 6 figures every single year. Not because they were doing anything wrong or illegal or because they had bad advisors, but because they were making 3 simple mistakes that almost every high-income family makes, and nobody had ever told them how much these mistakes were actually costing them. My name is Samuel Harnisch, and I'm the founder of Quantitative Financial Strategies. And after reviewing hundreds of tax situations for wealthy families making over 7 figures a year, I've discovered that the same 3 mistakes show up over and over again. These aren't complex tax code violations or aggressive strategies gone wrong. These are basic errors that cost families hundreds of thousands of dollars every year, and the frustrating part is they're completely preventable. Today I'm going to walk you through these 3 mistakes, show you exactly how much they're costing you, and more importantly, give you the specific steps to fix them before your next tax filing. Because if you're in the top tax brackets, every mistake you make gets multiplied by your income level, and what might cost a middle-class family a few $1,000s could be costing you a few $100,000. Okay, mistake number 1 is paying quarterly estimated taxes like a W-2 employee. One of the most common mistakes I see wealthy families make, especially those with multiple income sources, is blindly sending in massive quarterly tax estimates like they're on a W-2 salary. And the reason for that is most CPAs just want to avoid underpayment penalties, understandably so. But that might mean that they're overestimating your tax bill by a lot. And that might mean that you're handing the government $50,000, $100,000 extra early, only to get it back months later with no interest. And for high income earners, this can be a huge cash drag. You're effectively giving the IRS an interest-free loan on your money that you could have had invested growing for you, and then eventually you're just going to get back what was yours in the form of a tax refund. And the IRS safe harbor rules were built for your typical middle-class W-2 earner, not for business owners or investors with variable income. But too often, advisors just default to those rules without analyzing your unique situation. All right, mistake number 2 that I see is your tax advisor or CPA are not on the same page as your financial advisor. I can't tell you how many people I've come across that I have conversations with them and they go, oh no, I already have a tax advisor. And I'm like, that's awesome. I love that. I'm a financial advisor. That's different. I'm not a tax advisor. But what I do is I focus on tax planning from the point of view of a financial advisor. And they go, oh, that's great. I already have a financial advisor. But they reached out to me because they have some sort of a problem either outside of their portfolio or they're just not sure if their portfolio is being managed in the most tax efficient way. And sure enough, when I look at it, the financial advisor has almost no regard for taxes, and these multi-million-dollar portfolios are creating massive tax bills. And while you got that going on one side, it can be an incredible CPA or tax advisor on this side. All of the work that they are doing for you is being negated by the tax inefficiency of the portfolio your financial advisor has created for you. So it's not enough to simply say, I have a tax advisor, they handle all of my tax planning for me, and then my financial advisor handles the investments for me. That's no good. What you want is those two parties working together and financial advisors that are really paying attention to the unique tax situation that you're in. Because of the tools and strategies that are available now, you really shouldn't be getting large tax bills from your investment accounts. And mistake number 3, all things stock-based compensation. And this happens all the time with really smart, high-earning professionals. They're so focused in what they do for their job, they don't know all of the intricacies that come with the stock-based compensation that they're receiving. And so that might be huge RSUs that vest, and they don't quite realize that most of the employers are withholding based on a lower tax bracket than what they're actually in. And so they're going to fall short on withholding enough for the taxes to pay on the ordinary income when RSUs vest. Or another one is not realizing if you have non-qualified stock options, when you exercise them, you are going to trigger ordinary income taxes. And lastly, the sneakiest one is if you are fortunate enough to have incentive stock options or ISOs, it's not always the case that you can exercise them without taxes. If you trigger something called AMT or the alternative minimum tax, it's possible that you're going to owe taxes on the bargain element between the exercise and market value price of the shares that you have. And another little wrinkle with that is you're going to get an AMT tax credit, and you want to know how to apply that in future years. Now, before I show you how to fix these mistakes, I want to be completely transparent about something. These aren't necessarily problems you can fix by just switching CPAs or reading a tax book. They require coordinated planning across your entire financial picture and ongoing communication with the different advisors. At QFS, we work with families who have $5 million or more in investable assets, and tax coordination is a core part of what we do. We work directly with your tax team to make sure that all the decisions we're making are optimized for your situation. Obviously, we can't work with everyone, and this level of coordination requires significant assets and complexity to make economic sense. And if you're in that category and want to see if you're making any of these mistakes, go ahead and use the link in the description to book a call. But now let me show you how to fix each of these problems. How to fix mistake number one by optimizing your quarterly payment strategy. What you want to do instead is reverse engineer your tax liability. So that means projecting your expected income and deductions from charitable donations, tax loss harvesting, tax-aware hedge funds, etc., just so that you're not overpaying just to be safe. And you want to pay the legal minimum, whether that's 100% of last year's tax, 110% of last year's tax if you're a high earner, or 90% of this year's actual liability. So if your income is lower one quarter or your deductions happen to be larger than you expected, you're going to want to reduce your remaining estimate so that you're not writing these big checks on taxes you don't owe, creating that interest-free loan to the government. And when you do that, you have more of your capital available to invest and be compounding instead of in these outstanding interest-free loans that you're going to get back with a tax refund. All right, to fix mistake number two, you want to build your proper tax team. And what you really want, and what I do for people, is a tax-conscious, tax-focused financial advisor paired with your CPA or tax advisor working together. Because each of us are going to have different strategies or levers that we can pull that when we work together, we can double the effectiveness of your tax strategy overall. When you're evaluating your financial advisor, it's not just what were the investment returns they were able to get. It's what sort of taxes did they trigger along the way to make those investment returns? Or when you compare it to how I do it, it's what was the investment return plus the additional tax alpha, which you can think of as an additional return stream in the form of tax savings from the deductions that you got as a result of our investments. So you're really stacking two different return streams. One, the normal financial market returns plus additional tax savings, or what we call tax alpha. And how to fix mistake number three for stock-based compensation. This one's all about having the right tools available. So if we're talking about RSUs or non-qualified stock options, your primary source of tax right off the bat is going to be ordinary income tax. So if you have a properly calibrated tax-aware portfolio, you're going to want an allocation to tax-aware hedge funds that are going to be realizing an ordinary loss, which you can use to offset the income that's realized, one, when your RSUs vest, or two, when you exercise your non-qualified stock options. Then on the back end, let's say RSUs vested and you didn't sell the shares and now they're at a low basis and the stock has appreciated. Same thing with your non-qualified stock options, where if there's a large gain embedded in the shares that you now own, your problem there is going to be capital gains. And so what you want is you want to set up a long-short tax loss harvesting account that's constantly every month harvesting losses that you can use to offset the capital gains you'd realize when you sell those shares. And then lastly, for ISOs, you really need to make sure, check if your company at the time that you got those shares qualified for QSBS, which is an exemption that just got supercharged, which if you hold them 5 years from when you exercise, it's possible that you could be exempt from up to $15 million on federal capital gains tax. The reality is these three mistakes are so common that most wealthy families just accept them as part of being wealthy, but they don't have to be. Every dollar you overpay in taxes is a dollar that's not growing your wealth or being used for your family's future. And when you're in top tax brackets, these mistakes can get amplified to the point where they can cost you more than what most people make in a year. The good news is all three of these mistakes are completely avoidable with the right approach and the right team. If you want to see exactly where you stand and whether or not you're making these mistakes, go ahead and book a call using the link in the description. We'll review your current tax situation and show you where you could be leaving money on the table and what we could do, what we could save you if we work together. And even if you're not ready to make the change right now, you'll at least know the kinds of questions you should be going to your current team with. Make sure to subscribe for more videos on how sophisticated families are protecting and growing their wealth, and I'll see you in the next video.